Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. Thank you for joining us today. Today's topic will be maximizing Schedule C deductions. Whether you're a first-time filer or simply looking to refresh your knowledge, this webinar will provide you with valuable insights and practical tips on how to maximize your client's Schedule C deductions. Keep in mind that we do try to host one webinar per month, so please be sure to join us in the future as well if you find today's session to be informative. During the webinar, you'll be able to submit questions to the team and get those answered live. If we have time at the end, we will present those questions to everybody. And with that said, I'm very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He is a solution architect here at Wolters Kluwer. Ryan has years of experience working in the tax industry and will be sharing his insight on how you can maximize Schedule C deductions for your clients. So with that, let's get started. Ryan, please take it away.
All right. Thank you so much for the kind introduction. Yes, my name is Ryan. I'm going to be your presenter today. And today we're going to be going over what I consider one of the more common forms on a 1040, right? The Schedule C. Pretty much anyone who has a small business is most likely going to file a Schedule C. Occasionally, they may be doing a business return. It may be set up as an 1120S, or maybe there's some partners in a partnership. So by and large, most of the clients I work with are Schedule C clients. And one of the things with the Schedule C is really how the IRS has set it up is it can be as basic a Schedule C as you need, or sometimes they get very tricky, very in depth. There's all sorts of little deductions here or there that your clients may qualify for, and hopefully they're getting them. But I'm really going to be walking you through some of those more in-depth deductions and talk about when there's if-then scenarios. Sometimes there will be multiple ways to do a deduction. Think of vehicle expenses. Yes, we could just go and deduct the miles and be done with it. Or for some of our clients that have more in-depth financial records and they really keep all the receipts and they have good records for us to work with, well, we may be using an actual expense method. And you're going to see that all throughout a 1040, particularly on the Schedule C. Now, before we really get going and get into like the meat of this presentation, just to give you all just a brief background of myself so you know who's actually presenting this and speaking today. My name is Ryan Hubbs, and I do have my background in accounting. It's what I went to college for. It's what my degree is in. And I went to a very small school in the Appalachian Mountains, but after I graduated, moved up to Washington, D.C. And when I was up there, I worked for two CPA firms. And honestly, I did a little bit of everything. I did some audits. I did some nonprofit work. There's a ton of nonprofits up in D.C. But most of what I was doing was taxes, taxes, taxes. And I can definitely relate to the grind, or the struggle even maybe, of trying to get so much work done in a condensed amount of time. Now, in my current role here at Wolters Kluwer, I'm a solution architect. Solution architect is just a really fancy way of saying I'm a product specialist. It's really my job to, one, show off how our tax programs work, and then two, also I host monthly webinars like the one that we're on today, usually covering some different facet of the Form 1040 and talking about how to maximize deductions or things of that nature. Now, today's objectives, and specifically the things that I'm going to be going over, and I guess just kind of an aside here, how I typically try to set up these presentations is we usually get a pretty broad swath of people that come to this. And what I mean by that is some people are beginners, maybe they're just thinking about getting into preparing tax returns. Some are more advanced. They've been through a few busy seasons. So I try to keep the areas that I go over where some will be a little bit easier to understand kind of at the beginning. And you'll kind of see that based off the first bullet slide of identifying a taxpayer that is eligible to file a Schedule C. But as we continue to get into this presentation, we will get into more in-depth topics where even if you've done quite a few busy seasons, I'm hoping you'll be able to extract some knowledge from this presentation. After we go and identify if someone's eligible for the Schedule C, we're going to talk about some gray areas within the expenses section and how to report those to the IRS. And specifically what I mean by gray areas is, if you're going through a return and let's say you're inputting wages, it's not really a gray area, right? It's listed directly on the form. Here are the wages for this person. I type it into our software and it's doing the calculations for us. But when you get into your Schedule C's, Schedule E's, more and more likely that the tax code is going to become more and more complicated. And there's going to be scenarios where a client is explaining their situation to you. You're looking at, how the IRS says they want to report it in their instructions, and it's not always abundantly clear what we're supposed to do. We're going to be talking about some of those gray areas and hopefully run through a few examples that I've gone and prepared for you today. After we do that, we'll be understanding the pros and cons of using the mileage rate or the actual expense method when it comes to deducting vehicle costs. I can tell you when I first started preparing taxes, a lot more work typically goes into the actual expense method. So I thought it was always going to be the higher deduction. That's really not the case, right? If you've been doing taxes for a while, you know that sometimes there's nothing wrong with the standard mileage rate, and many times, surprisingly, it will give you a higher deduction. But we'll kind of walk through both of those, and we'll really talk about when you're going to want to use each. Then we'll have some two smaller little items that we're going to go over towards the end of this, where we'll talk about some of the issues for self-employed individuals if they're filing a Schedule C. Most certainly they are self-employed, right? And sometimes with a lot of the people that I work with, their Schedule C is just one of the many gigs or many jobs that they have, right? And sometimes there can be overlap between different businesses, different side gigs, and we'll kind of talk about some of those issues. Then lastly, we're going to talk about some tax research tools that we have in order to look up some of these deductions. There's only so much that I can go over in one of these presentations, but I want to just, make you aware of a couple tools that we have or that you can use. That if you run into an area where you're not quite sure about, it's going to give you some guidance and hopefully some peace of mind that you're doing everything correctly. Now, starting off with our first bullet point, let's just kind of start with the basics here and identify if a taxpayer is eligible to file a Schedule C. Well, the IRS has given us some pretty clear guidelines on when to go ahead and attach this form to their 1040. And I think the first bullet point is probably the most important one, right? The activity is pursued with the objective of making money. Pretty much every business I've ever heard of, they want to make some money, right? And why I have this bullet point on here is just to delineate that, it really does need to be their primary purpose. If you have a friend and let's say they're a carpenter and maybe they make some furniture on the side, and yes, they even sell that furniture, but they're really not looking to turn a profit, right? This is more of a hobby. This is something that they enjoy doing. Well, if it's a hobby, that is almost like the first gray area that we could talk about, where you may have to make that distinction of, are they taking this seriously? Are they really trying to go and make money? Or is this business just going to be a hobby? If it's just a hobby, you will still need to go and report the income that they make. But you may be able to get away with not filing the entire Schedule C. And all throughout, one of the things that I've learned in this profession, having been in it for a little over a decade now, is all the time you're going to have to go and make judgment calls on, should I do this, should I do that? And a lot of times, as long as you have a good basis for why you did what you did, the IRS will accept it, right? Now, there are limitations to that. Sometimes the IRS is a little less forgiving, but by and large, as long as it makes logical sense, a lot of times, they'll rely on your professional judgment. Now, the only little caveat to this Schedule C where the activity is pursued with the objective of making money is really the second bullet point here. Your business isn't a corporation or a partnership. And I kind of alluded to this at the beginning of the presentation, where how they set up their business when they are either first getting started or first setting it up is going to be very important to how we're going to report it to the IRS. If they just kind of one day decide they're going to go and create a business and they just get going and they start advertising and offering a good or a service, probably going to be a Schedule C, right? But if they've gone through the process of actually incorporating or setting up different partners in a partnership, and there's going to be multiple people, if they have filed those forms specifically with the government, then they may be a corporation, they may be a partnership. In that case, you're either going to file the 1120, 1120S, or 1065. It's going to be a completely separate return from their 1040. But usually our clients will know how they're incorporated. Hopefully they will know, right? And they should be able to make that distinction for you. You could also go to some of the databases that are offered by governments to look this up. Excuse me there. Now, a couple common questions that I get is, do you have to file multiple Schedule Cs if there's multiple business activities? And do businesses with a tiny amount of income and expenses have to file? Well, to answer the first question on the multiple Schedule Cs, if they have a business, but this business is making money through a few different ways. Let's say they have some rent, they're offering some services, maybe they're selling a few things here and there, but it's all under the same umbrella of that business. You're only going to have to file one Schedule C. But if they have many businesses, and I think we all have clients like this, right, where they have one business that offers a service, one business that's completely separate. Maybe they're selling makeup, they're selling something completely different, and they're all kind of very different, unrelated activities. That's when you're going to run into the situation where you might have multiple Schedule Cs. And why the IRS really makes you jump through this hoop and makes you do it in this manner is when it comes to the expenses, when it comes to the deductions, for many of these, they may not overlap with one another. Now, the thing with the IRS tax code is it's very complicated. There's always exceptions to each rule. It doesn't always completely make logical sense. So there will be areas where the overlap does deduct, but by and large, a lot of times it's going to treat each Schedule C as its own separate entity, and some of those deductions aren't going to flow from one form to the other. Now, the next question that we have, do businesses with a tiny amount of income / expenses have to file? And the reason that I have this question on here is that I had a friend named Danny, and he was a plumber. And I'm going to be referencing him quite a bit throughout this presentation, as I think he's going to serve as a good surrogate for some of your clients that you may have in mind that either tell you off the wall things that are probably not true, or definitely not true, or just generally have poor accounting practices. They're not really giving you good financial information for you to make your determinations of what you should do with them on. And, it's really those clients that are going to cause us the most stress on if we're doing this correctly. And if we make a mistake, what could the potential consequences of that mistake be? And then two, just really making sure that when we do get into those situations, that we're using all of the tools at our disposal to make sure that we are protecting ourselves and doing things that are within the guidelines that the IRS has given us. And one of the things that Danny would always say is he was a plumber and he did have a business, and it was a Schedule C business. But I can tell you, he did not take it very seriously. He would kind of work when he wanted to work, or he would make appointments, blow them off. He just kind of wasn't a very professional worker, right? And he would always tell me, well, I made so little money last year, I don't even have to file a tax return. He didn't even know what a Schedule C was. He was talking about his 1040. And I would say, Danny, that's really not true. You're going to have to report the income, even if you don't owe taxes. You're going to have to report this income to the IRS. And we would go back and we would go forth. And some years he would file his taxes, some years he wouldn't. I stopped doing them because I just thought it wasn't worth the risk. I was doing it for free anyway, so I didn't really want to open myself up to all those liabilities. But I think you all probably have a couple clients like that are very argumentative. Maybe they haven't looked up the facts, but they're so sure that they're right. People like that. Well, that's who I mean with Danny the plumber. And I would always tell them, yes, you do need to go ahead and make sure you're filing your tax returns, get them on record. I promise you it's going to matter down the line if you ever get audited or the IRS comes for you for back taxes. Unfortunately, he did not listen to me. We'll talk about some of those consequences later on down the line. But before we move forward to some of the other items that I've prepared to talk about today, do want to go and open this up to a polling question. I find this to be an interesting polling question because when I was fresh out of college, my manager actually asked me the question I'm about to read to you, and I got this wrong. I definitely got this wrong. So I always like to include it in this Schedule C presentation. And that question is going to be, if you find $20 on the ground, should this be reported as income? And specifically, I probably should have added to the question on the Form 1040 or really on the Form 1040. Like, is this income that you should be reporting to the IRS? So I'm going to go ahead and open this up, the polling question. I'm going to give you all maybe a minute or so to answer, and then we'll kind of talk through what the correct answer is and how this is most often being reported, and we'll kind of go from there. So I'll give you all just about a minute or so, and then we will go ahead and continue on. Okay, and it looks like we've had about 70% of the people that have voted. We're seeing a pretty wide distinction here in the answers. We got about 32% that say yes, 55 that say no, and 14% that say not sure. If you're not sure, I appreciate the honesty. This isn't a test. We're not grading you here. So you don't know, you don't know. And these polling questions, these are really helpful to me as I do one of these presentations typically about once a month. And with these, this helps me know that the content that I am giving you is relevant and actually got this wrong. The answer is yes. If you find $20 on the ground, this, I think, keyword here is should be reported as income to the IRS. However, I know practically how many of us are really doing this, right? If we find $20 on the ground, are we making a note of this? Are we making a log? And really, reporting this to the IRS? Probably not. I can tell you, I don't even think most of the people I know in the profession would even do it if they found $20 on the ground. But typically, or I should say, the answer technically is yes. And the reason that I like to ask this question is just to kind of set a mindset that even if you're not going to owe money on something, by and large, the IRS still wants to know. They like to capture data. They like to know what's going on in case they ever need to do an audit. They want to feel like they have the most complete financial records within that tax return possible for them to then go and make any distinctions. If you're not reporting the $20 that you found on the ground, I wouldn't feel too bad about it. I don't think it's ever going to get brought up, but technically you are supposed to do this. And moving forward with this presentation, I really want to start to get into some of the gray areas. And the first gray area that we're going to talk about today is going to be travel expenses. Now, I can tell you when I was fresh out of college and doing a tax return, someone once told me that if you go on a trip and you do a little bit of business and you go to Disney World, well, all of the lodging for that week would be deductible. And I almost didn't believe it. It seemed too generous. You always hear these stories about how the IRS, they're just here to take your money. But when it comes to some of the deductions and how things are set up, I'm often surprised with how generous they can be and really where you can deduct, in my opinion, things that clearly weren't part of the travel expenses because you're on vacation as well, how you can deduct like the whole amount. But there's always going to be certain guidelines that are really set up that are going to give us kind of a roadmap or guardrails on when we can do something and when we can't do something. And just kind of right off the bat, do want to go over some of like the clear qualifications that the IRS has set for us. And the first one on your screen might seem pretty intuitive. You need to leave your tax home. Well, if you're traveling, you are probably going to have to leave your tax home. However, it's a little bit more in depth than just waking up one day, getting in your car, getting on a plane, and traveling somewhere. Living in DC, in DC, Virginia's right there, Maryland's right there. You have the city of DC, which is its own separate entity right there. I went to a tax conference where I drove from Virginia to Maryland, and it was only about a 20-minute drive, right? It's very, very close, all those, that whole area. And my normal commute to the office was also about 20 minutes, but I went in a different direction. And even though I went across state lines, really went through Virginia, through DC into Maryland, because it matched the same distance and same timing of my normal commute, even though I left my tax home, it technically did not qualify as a travel expense, as it was kind of within the ordinary daily flow of what I was doing anyways. Second item here on the list is going to be a little bit more kind of black and white. You need to plan the trip in advance. And what I mean by planning the trip in advance is obviously you need to go and plan on doing something, but it can't be a spur of the moment decision. If you are going to a concert, and let's say this is a great concert that you've been looking forward to going, and it's all the way across the country. You've traveled from the East Coast to the West Coast or wherever. And at the last minute while you're on this trip, you realize you have a business client in this state. You're going to go ahead and tack on a quick meeting so this can be a travel expense for your business. Well, not going to quite work like that. What you are going to have to do is plan the trip in advance, but also you're going to have to plan out the meetings and the business purposes in advance as well. If it is a spur of the moment thing that you kind of just tack on right at the end or while you're in the middle of this trip, really is the best way to put it, not going to qualify as a travel expense. So make sure that when either you or your clients are planning these things out, that you know what the business purpose is going to be. And that really leads us into our third point. This trip needs to be an ordinary and necessary expense. And really what this means that it needs to be within the normal course of their business. If they are going on a trip and let's say The ordinary course of their business is they're selling something, right? They're selling parts, they're manufacturing, whatever it may be. And then they go on a trip and they want to go and talk about offering services that are unrelated to their normal core function of the business. Well, that would not be ordinary and necessary. And really, the last point on the screen is the trip must consist of mostly business. And I think the key word to know here is mostly. And let's go ahead and talk about what I mean by this. So what I've gone ahead and prepared is a slide that says gray areas, as you're going to see. It's not always abundant what mostly business means, abundantly clear, I should say. And what I've done is I've set up a travel schedule. And this is a 6-day travel schedule where Thursday they are traveling to Florida. Friday, they are going to a rental property seminar. Then on the weekend here, Saturday and Sunday. On Saturday, they're going to go ahead and go to Disneyland. On Sunday, they're going to go to Universal Studios. And then Monday, they're going to meet with some clients. And then Tuesday, they're going to travel home. So we really have 2 days that are travel, 2 days that are clearly business purposes with the seminar and meeting with clients. And we have 2 days that are pure vacation days, right? They're taking the family to Disneyland. They're going to Universal Studios. And this is what I mean by gray areas. Is this something that you would consider mostly business? Well, how I would initially view this is no, it wouldn't, because they're only doing work on really 2 of these days. It's really just Friday and Monday, right? However, with the IRS guidelines, you always have to kind of go back and check. And how they've set up this trip is very important. The flow of the days, where obviously we have our travel days on the ends here on Thursday and Tuesday. Then we have work Friday and Monday. And then the fun is right in the middle on Saturday and Sunday. Well, this is a very common, technique or plan that you can use to deduct a lot of additional travel expenses called the weekend sandwich. And because they set it up in this manner where the fun days are sandwiched in between of actually going to this seminar and going to the meetings with the clients, because it's set up in this manner, it's actually the IRS, I should say, is actually going to allow both of these travel days, both to and from Florida, to count as business days. Even though we didn't meet with clients, even though there was no clear business function, they're actually going to allow it to count as travel days. So in this instance, with this travel schedule, this would qualify as mostly business, even though they were really only doing things to enhance their business on 2 of the 4 days. And this is really what I mean when it comes to gray areas, where it's not always abundantly clear what the right answer is. If they had gone and changed up the ordering of this, where Friday and Monday, instead of doing the business functions, they were at Disneyland and they were at Universal Studios, and then they sandwiched the seminar and the meeting with the clients on Saturday and Sunday. In that instance, it actually would not have counted. Those travel days would not have counted as business days. And this is the thing that always, really to this day, drives me a little bit crazy with the tax code, is it doesn't always seem to logically make sense. Like, what does the ordering have to matter if the same function is the same? But these are the things that you kind of have to know in order to get the biggest deductions for your clients. And it even gets a little bit more complicated when we go and jump to scenario number 2. When we go to scenario number 2, well, this is an international travel schedule. Before we were doing domestic travel, where we were traveling, within the United States. But if we go and change up the ordering here, we're now traveling to England as opposed to somewhere in the US. Well, I've set this up where it's clearly not a weekend sandwich kind of format, right? We have a travel day where we're going to go ahead and fly to England. Friday, we're going to meet with some clients. And then Saturday, Sunday, Monday, all vacation days. And then Tuesday, we're traveling home. So it's the same length of a trip. We're clearly only meeting with clients or really performing that business function on just Friday. And this would also qualify as mostly business. And the reason that this would qualify as a mostly business item really is because this is international travel. The difference, the rules that govern domestic travel and international travel, completely separate. For domestic travel, the mostly business criteria is going to be 50% of the time. When it comes to the international travel, for reasons I cannot discern, the IRS actually drops it down to 25% of the time. So that word mostly that we've been focusing on, it even changes based off where they're traveling. And with this, obviously we just have the one meeting, but since those travel days are going to count most likely, or not most likely, they are going to count. this is still going to qualify as mostly business because it's hitting, really over 25% of the time based off this format, really 50% for this example. And furthermore, there's even more deductions that you can take. Like, when I think of travel expenses, I think specifically of like a plane or gas, or I'm taking a train. But even the lodging for both of these scenarios, whether it's the domestic travel, whether it's the international travel, this is going to qualify too. So if we go back, let's actually go back to our domestic travel. They're going to Disneyland on Saturday, going to Universal Studios Sunday. The lodging for these days would also be deductible as well. They can deduct the lodging for all of these days. Furthermore, just to really get you thinking about how much can be deducted, the meals for the travel days, also deductible. Now, there will be some limitations on those meals, as meals are kind of their own little separate entity with how they're taxed by the IRS. But you'll still be able to take most likely 50% of those meals even on the travel days. So once you're hitting these thresholds and criterias, particularly when it comes to travel expenses, there's a whole lot that you can deduct, right? It really starts to get very generous with, the determinations of what can and cannot be deducted. Now, moving forward with this presentation, where I actually want to go next is I actually want to jump into a tax return. And what I've gone, and it looks like my tax software here has logged out, so I'm going to go ahead and log in one more time. So just bear with me for 1 second. And when I log into my tax prep software, TaxWise, I'm going to go set up Danny the plumber here with a little pseudo tax return that we can use to kind of work through and talk about how we're going to go and report these items. Well, when I open up Danny's tax return, I've already done some of the basic data input, so we can kind of skip over that. Really where I want to go is I just want to go and jump to the Schedule C. And with this Schedule C, already put in kind of the basic business, social security number, what's the name, etc. But as we scroll down, I went and put in some gross receipts and sales. Now, I can tell you my Danny was not open, not making $100,000. But for the purposes of this presentation with some of these deductions, I think what you're going to see is he owes about $5,200 on his federal tax return. He would not be very happy about that. But as we go through and start to fill out some of these deductions, we're going to be able to get this amount quite a bit lower, may even flip to a refund depending on how much deductions he has. Now, with advertising, a couple things to kind of be aware of is really the general purpose of the advertising needs to be to get your name out to the masses, to the people, letting them know that you're a business. And the IRS is not really all that particular on what can count as an advertising expense. I think we all know like the basics, right? Like they have a billboard, they take out a radio ad, even if they go and make some flyers, they hand them out. All of that I think is pretty clearly advertising. But what if you run into a scenario where they've hired a graphic designer and they need a logo for their business? And this logo is going to be plastered everywhere, but it's not necessarily like for a campaign. It's just going to be the logo for their business, that everyone's going to see, whether they're advertising on their work truck, on a billboard, etc. Well, the IRS is even going to go ahead and allow that to be deducted as an advertising expense as well. And when it comes to inputting this information, I'm just going to go ahead and say there were $5,000 in advertising expenses. We're going to see, okay, look, that's a pretty significant downward jump in the federal balances due. And as we go through this and start to go to something like travel and meals, what we're going to see is that travel and meals, I'm trying to just highlight this one little area, here we go, are not necessarily going to be deducted at the same rates. By and large, when it comes to your airfare, your gas can be a little trickier, but airfare, or if you take a train, that's lodging even, that's going to be different than how you deduct your meals. So how you can see the software breaks this down is we have travel, which is really, think of airplanes and things. And for that, I'm going to say they had $1,000. We're going to see this taxable amount due continue to drop down. But when it comes to the meals, by and large, most meals are deducted at a 50% threshold. Occasionally, you may run into instances where you can deduct them at 80% or 100%, but I'd say most commonly, half the meal is going to be able to be deducted. And for this example, we're just going to go ahead and keep it at that. Now, one thing to kind of talk about with this is I want to kind of talk about accounting records and bank statements. With my Danny the plumber, one of the things that always drove me crazy was he basically had one credit card or debit card. I can't remember the exact distinction of what it was, but more or less, he basically had one that was for his personal and for his business. He did not have separate cards based off how he was using them. So when you would go through later on down the line and try to figure out, okay, like what did he spend that is deductible? You just have a bank statement that was a jumbled mess, right? And he would, go to meetings with clients and take them out to dinner. And yes, that would be a deductible expense, right? But what happens if he just went to the bar and he just had some drinks and he wasn't really meeting with anyone, but it was on the same credit card statement? If your clients are not giving you clear and distinct records, it really opens you up to a lot of liability because you're going to have to make a lot of judgment calls where the answer is not abundantly obvious, and this can really open you up to some liability down the road if they do get audited. One of the things that I would always press your clients and try to get your clients to do is that if they have a business, it needs its own card, whether it's a credit card, whether it's a debit card, doesn't really matter, but it just needs to be completely separate. So when you're getting these bank statements of the expenses, you know that as long as they've used it in the manner that you've told them to, these are all going to be items that are deductible and at least reported to the IRS. And then, you really won't even have to worry about what their personal expenses are. It's going to take a lot of the work out of, really going through and parsing through these bank statements and trying to figure out, okay, was this a deductible meal that they had? Was this them going to the bar? Who knows? It's like impossible to figure out, right? And then whatever you do, you never really feel quite that great about it because you're not quite sure that you got it right. So if you can get them to use different cards for their business as opposed to their personal, etc., really going to take a lot of that worry, a lot of that, judgment calls out of your hands and put it back into theirs. Where, ultimately, if they do get audited, you can just say, look, this is their business card. They gave it to me. All the expenses on here are supposed to be for their business. If they put something on there that wasn't, that's not my fault. That's not something that, that's not what I told them to do. I said to take all their personal expenses, keep that completely separate. Really is starting to build up a clear degree of separation of your liability, right? Because you're just going to go back and say, look, I told them not to do this. They should not have done this. I did the best based off the format and the systems that they have set up. But as we go through here and look at some of these different items, I'm not going to go through each and every one of these possible deductions that are on the Schedule C form itself. I think some of these are relatively self-explanatory, like office expenses, for example. There's really not a lot of interesting or gray areas to talk about when it comes to office expenses, repairs and maintenance. By and large, I think pretty straightforward. Same thing with supplies. But where we could get into one of those other gray areas is car and truck expenses. And within TaxWise, to actually fill this out, we're going to go ahead and add in an input sheet that is going to go and really break this down for us. It's going to be this one right here, the vehicle expense worksheet. And once I go and input this worksheet, I haven't really put any work into this. We're just going to go ahead and say that Danny the plumber here had a large van. Let me go ahead and type this in, and then we're going to scroll down a bit so we can see that there are two very clear sections. We have business miles, we have total miles, and then we have a whole bunch of expenses that are listed down here. Well, this worksheet in particular is for the actual expense method. And when it comes to deducting vehicle expenses, we're really going to have two separate options available to us. We're going to have mileage method and we're going to have the actual expense method. Now, when actually preparing a tax return, the one that's going to be, in my opinion, quite a bit quicker and easier to go and fill out is the mileage method, right? We just get a mileage log from our customers. Sometimes they just estimate what their miles were, and surprisingly, as long as that estimate has some basis, some facts behind it, the IRS will, by and large, accept estimates. Now, I always feel better when I have the log because I can keep it and I keep it for our records, but you're not always going to get that. And the point that I'm trying to get across is that's okay. You don't always have to have the exact miles that they've driven, but more or less the mileage method is just going to go, and for each mile that was a business mile, you're just going to deduct a certain percent of that mile. And the rate changes year to year. Typically, it goes up a little bit every year. But one of the important things to know about the mileage method, a common question, or I guess a common error more likely that I see is sometimes they will go and use the mileage method, and then they will go and also do depreciation for the asset, meaning the vehicle. And that would actually be incorrect. If they are using the mileage method, one of the things that you have to know is that the mileage method is going to include depreciation within the mileage that they're getting. And this depreciation amount does go up every year. This depreciation amount is actually not a great thing for your clients, but more or less each mile that they drive, this is going to be the depreciation that they're going to deduct. And keep in mind that you are going to have to keep a track of how many miles they tracked on their tax return and how many or what percent here, what percent they're actually putting towards depreciation. And the reason for this is going to lower the cost basis of the asset. So if they bought a car, let's just say hypothetically for $40,000 or a van or whatever, each mile that they drive, it's going to reduce their cost basis, by this amount. So if they come on down the line and actually sell this car, well, you're gonna have to deduct the cost basis, right? So this is actually going to minimize the taxable benefit they're going to get, because almost certainly they're going to be selling this vehicle for less than they had originally bought it, right? And so for each mile that they drive from that basis of $30,000, it's going to go down by this, this amount. So you will have to track it, and you can see it changes every year. So, how much is being deducted per mile is generally going up every year. And down the line, this will cause your clients to save less money, but you do get to deduct this, kind of on a yearly basis on their tax return. And one of the things to kind of point out, I kind of talked about this earlier in the presentation, is that sometimes the mileage method will give you a bigger deduction than the actual expenses. If we go back into our tax software and look at the actual expense worksheet that we have, there's a lot going on, right? This is a lot more than just saying, okay, they drove this many miles, we get this many cents per mile, this is their deduction. But just because you're filling all this out does not necessarily mean you're going to get a bigger deduction than using the mileage method. And I think the more tax returns that you've done, and additionally, the better records that your clients are giving you, are really going to kind of let you know just at a glance, is it going to be worth my time to even go and fill all this out? And what we're going to do for this is we're going to fill out this large van actual expense method live. And we're going to go ahead and say that Danny drove 20,000. Oh, no, we're going to say he drove 10,000 business miles. And then he had 10,000 miles of personal miles, which would bring us up to a total, obviously, of 20,000 miles. And once we tab over, well, it's doing the percentage for us. So it's just saying, okay, this is 50%. If I were to change the personal miles to just 5,000, you'll see that the percentage has now changed as well. And so once we go down to the different sections of the actual expenses that can be deductible, software is just going to do the calculation for us. So if Danny went and had $2,000 worth of gas, we tab over, we'll say, okay, the total amount is now 2,000. We're taking half of that. That half is based off the mileage mathematical equation that's occurring up here. We'll say that he went and got his oil changed a couple times. It's actually gotten quite a bit more expensive recently to get your oil changed, is one of the things I've noticed. We'll say that he got some new tires. We'll say that was $600. And as we go through, we'll say he had insurance of, we'll say $200 a month. Go ahead, put that in there. And then lastly, we'll say he went and got his registration. That was another $250. And then lastly, we'll say there are some personal property taxes. I think in Virginia, based off what his vehicle is worth, that'd be somewhere in this ballpark range. And we have a total expenses of $6,000. And then we have half of this being deductible. Well, we're going to see, okay, this is $3,000. Half of all the expenses are deductible. And when I was doing Danny's tax return, the few times I did it, I can tell you I never filled out this worksheet. This is purely just for an example to show you how the actual expense method works. Reason I never filled out this worksheet is I never had the underlying information where I felt comfortable filling out this worksheet. I never got clear receipts, or I never even got accounting records of, these are the items that I spent throughout the year. And when I ran into clients like that, just right off the bat, I can tell you I was always using the mileage method. I was going to take as much guesswork out of it as possible to just make sure that whatever information I have, even if it's an estimate of the miles, that was going to be my basis for taking the deductions with the IRS. And, really, I think the more returns you get and do, you'll kind of be able to see how many business miles they drove. And a lot of times it becomes very evident which one is going to be the greater tax deduction benefit without really having to go through each and every item. All right, so last little thing that we're going to talk about as far as different deduction types is going to be, let me go ahead and bring back my PowerPoint here. It's going to be office expenses. Now, this one is a bit more personal to me as I do work from home, and there are really two different options available to you. You have the simplified method, you have the actual expense method. And if you kind of were grasping what I was saying about how the auto or the vehicle expenses are working, it's very, very, very similar. If you can do one, you can typically do the other. And with this, if we go and scroll, well, let's just go and talk about the differences before I scroll to the next slide. The simplified method, instead of using miles like we would with the vehicle, this is going to go ahead and look at what is the square footage of the office, and then we're going to get a flat deduction rate based off the square feet. Now, the IRS is going to cap this, so even if they're using a mega room in their house to go ahead and use their office, simplified method may not be the best method then because the actual expenses could be higher. And if we go and talk about actual expenses, well, if we go back and look at our vehicle worksheet, it's basically the same thing, but for an office. And where you're going to really hit those gray areas is what about the insurance for the house? What about some repairs or renovations that were made to the roof? How much of that is going to flow through into the actual expense method? And that's really when you'll have to make some of these distinctions and determinations. Now, if we go ahead and move on over to the next slide here, what we're going to see with the actual expense method is we're going to need to break these things down between direct expenses and indirect expenses. And direct expenses are going to be things that were done specifically for that office. And the two examples I have here, if you went and redid the flooring, maybe you put some new carpet in, or you were ripping out the carpet, putting in hardwood, but you were doing it just for the office, that's when you would consider that to be a direct expense. You went and got painting supplies and painted that office a different color, well, that's going to be an expense directly for that office. In that instance, you're going to be able to take the full amount of the expense. But where you get into these gray areas is really the indirect expenses. The mortgage interest on their loan, the taxes associated, the real estate taxes associated with the house, utilities that are like electricity that are house-wide, right? There's really not a way to track the utilities for just the office. And with these, if you are using the actual expense method, you are going to have to go and make a determination on what is the total square footage of the house, what is the square footage of the office within the house, and then you're going to have to figure out what that percent is, and then that percent can be used as your actual deductible expenses using the actual method. So just to keep the math simple here, let me go ahead and bring up a calculator. If they had a home that had a 500 square foot office and the complete square footage of the home was 3,000 square feet, they would be able to take roughly 16 to 17, this exact number. They would take this percent, 16 and 2/3% of their mortgage interest, of their taxes, of their utilities, of their repairs, etc. So you may have to do this calculation. Very, very rare for us to get architectural blueprints to really figure this out. And a lot of times we're going to have to rely on what our client is telling us, right? And even though I would consider that an estimate, a lot of times the IRS is going to be okay with having an estimate as long as it's close. If it is way off and they get audited, there may be some explanations that are needed. But as long as it's in good faith, as long as they're getting it pretty close, usually that's going to be more than enough. Now, moving forward to the simplified method, this is going to be very similar to our mileage method, where you're going to get $5 per square foot. So for our particular example, what do we have the office size here? We had it at 500, so we would do 500 times $5 per square foot. Well, that's going to equal $2,500. Now, one of the major drawbacks, one of the limitations of the simplified office deduction, it's going to be capped. It's going to be capped at $1,500. So even though this would technically be $2,500 based off our calculation here, we're only going to be able to take 15. We're going to take the full amount of the simplified method, and that's just what we're going to get. And once again, as I've stressed many times throughout this presentation, this is my preferred method when I am not getting really good financial records. If they cannot clearly say this was their interest, or here's their real estate bill for their real estate taxes, I should say, or I'm not getting the utility bills. Well, why even go and mess around with it and just try to figure out an average or estimate with the few bills that you got? Just go ahead and give them the simplified office deduction. A lot of times, I will end up putting in the work for the clients that give me the records where I can do that for them. If they're not going to give me the records that make me feel comfortable reporting these deductions to the IRS, I remove as much risk out of it, not only for myself, but also for them. Now, last little thing to go over here. Looks like we still have about 5 more minutes of time. One of the things with the Schedule C, or really just any tax form, whether it's a 1040, 1065, etc., is the tax law is somewhere between 10 to 20,000 pages long, and that's far too much for anyone to ever completely memorize, right? And even if you could kind of get the general theories and logic down of the tax law, there are so many exceptions to the rule, it gets very, very confusing. And what I always recommend most tax professionals to have, most tax preparers to have, is you typically want to have some sort of research that you can look these things up. And what I particularly use is something called Answer Connect. I actually used it to set up this particular presentation. A lot of times I'm really relying on my software to do a lot of these calculations for me, right? I'm relying on TaxWise to do them for me. But when I need to go through and really explain and go to the ins and outs of, why one method may be better or what are different limitations, I'm actually using Answer Connect to go and answer these questions. And with Answer Connect, what I like about it particularly is this is going to be, oops, wrong, little link to click there. This is going to be something that is directly through your web browser. So when I go into Answer Connect, we'll go ahead and log back in again. When I was going through and looking up the actual method and the simplified method for the home office deduction, I was I didn't quite remember all the indirect expenses. And I kind of needed a little bit of a refresher on some of these items. Well, I just went ahead and did a home office deduction, typed it into my tool here, and it gave me a whole bunch of different topics. It gives me, kind of like a snippet, but really what I used were these different topics. There'll also be different explanations as well. And, topics are going to be more so high-level items. Think of general overviews if you're really not quite sure about something. Explanations will typically dive into more detail for a specific example. And why I always use this, or, many times when I'm doing tax returns for a client, I'm not always, sometimes it strays into areas I'm not an expert in, right? Well, this is my basis for electing to do the things that I do. And this is authoritative tax research. If my clients get audited and I can point to it and say, well, I did this because it's an Answer Connect, that is a sufficient explanation to the IRS. And, before I was using something like this, I was using Google. But one of the things that would drive me crazy with using Google is I may read 3 different articles on the same sort of thing, the same sort of deduction, and I might get 3 different explanations on what I should do, right? And one of the reasons you run into that is the people that wrote those articles are not necessarily properly vetted. And I can always see, okay, Robert was the person that wrote this article, and look at the alphabet after his name. Robert is a JD, MBA, and a CPA. And he works for us. So we know that as the tax law changes year to year, Robert and his team are going to go through here, and they are going to go and, in a timely manner, change these articles to make sure it matches the current tax law. This is a relatively inexpensive add-on that you can get with Wolters Kluwer. I always like to highlight it in these presentations because this is what I use to make these presentations. I probably have about 80% of these presentations just memorized from doing it so many times. But when I'm not quite sure, when I run into one of those gray areas, this is the tool that I use, and I highly recommend it for any tax preparer as well. So with all of that being said, this is going to go and conclude my presentation here today. But before I go and end this webinar, there is one more polling question that I would like to open up, and it's going to be, let me scroll through a few things here. Would you like a more in-depth product demo and further details about TaxWise Online? And TaxWise Online was the software that I was kind of using today to help get this tax return ready to be filed. And the reason that I ask this is it's really part of my core job here at the company to give one-on-one demonstrations to potential clients. So if you are thinking about making a switch in tax software, or you're just getting started and this will be your first tax software, if you feel like you need a more in-depth product demo on how it all works, how you're going to navigate it, fill it out, etc., just let us know here. We can have a sales consultant reach out to you, and we can schedule maybe a 30-minute long, potentially even an hour-long demonstration where myself or someone on my team can go and walk you through this. So I'll give everybody about a minute or so to go ahead and answer this, and then after that, I'll do a quick outro, and we will go ahead and be ending this presentation. Okay, so let me go here and see. Looks like most 77% of you answered, so I'm going to go ahead. We'll leave this open for the time being, but I'm going to go ahead and close out this presentation. Now, the last thing that I really want to say to everyone is I've done many, many busy seasons. Now, I don't really have to do as many as I used to. And right now we're in October, so we still have a couple more months of hopefully low stress. I want to say stress free, but low stress of the tax returns that we're doing. But busy season is right around the corner, so I just want to take a moment to really wish you all the best of luck. I hope some of the knowledge that I talked about today was insightful for you and maybe that you'll practically use it. But also, I hope that busy season is a very lucrative time for you and relatively stress free, or at least less bumpy, is the way I always describe it, not too hard on y'all. And with all that being said, I am going to go ahead and end this presentation. Be on the lookout for more virtual tax schools. We typically go over different facets of the 1040, typically host one of these a month. So if you found this helpful, please sign up for next month's, and hope to see you all again. Thank you so much, and really appreciate you all. Thank you.